Hi, welcome to Coffee Break Accounting with me, Becky Brooksbank. If you haven't already done so, press pause here and go and grab yourself a cup of tea and coffee and join me for 10 minutes or so of jargon-free business support for your business. We are well into series 3 now, and we have been following our way through Beyond the Profit and Loss. This series is called. Okay, so the first session of series 3 was looking at cash accounting, and last week we had a look at traditional method of accounting. So what I'm trying to do is take you further than the profit and loss account and realise that there is so much more that you need to know outside of just how much your profits are, and I'm trying to help you understand that in a simple way so that you can choose how to implement in your business. So if you remember last week when we were looking at the traditional method of accounting, otherwise known as accruals accounting, we said that we would recognise items in our accounts when they are billed or invoiced to us, rather than at the point when the cash transaction actually happens. So we get a better balance of matching income to expenses, so that we don't see this disparity of ups and downs when we purchase things within the business. And if we reflect back to the example of Mr. John Tapp, if he bought a bathroom suite, say for example at March, but the job wasn't till the end of April, on cash accounting he'd see that as an expense in his books in March, and then the income would come in April. But under traditional accounting, it lets you match the two off in April as and when the economic benefit is received. So what does that mean? So that means that actually there is a number of transactions that happen that don't go through the profit and loss account with traditional accounting. And where do we put them? The answer is the balance sheet. So this is what we're looking at today. So if you adopt a traditional method of accounting, you will have two main reports for your business. You will have the profit and loss account, and you will also have the balance sheet. Okay. Now, just flipping there, if you want to know more about the profit and loss account, feel free to head back in the Coffee Break Accounting series to series 1, where we covered everything to do with the profit and loss account. Okay, just a little aside there. So today we're going to concentrate on the balance sheet. So really important to think about what actually is the balance sheet. Okay, so a balance sheet is a report that shows the company's assets, the liabilities, and the shareholders' equity if you're a limited company, or it would be the owner's equity if you were a sole trader or a partnership, otherwise known as capital. Okay, so the balance sheet is a report that literally shows all the assets, the liabilities, and the owner's return, for want of a better word, on the business. Okay, and an asset we're going to define as a resource that's owned or controlled by the company. So it's really important that it's within your control and is owned by you, that will provide benefit in the future. Okay, so it becomes an asset. So an asset actually is something really good for a business. Okay, because it's something that will generate us some benefit. We're going to use it over a period of time, perhaps. A great example for John Tapp. So if you haven't, if this is the first time you've tuned in, John Tapp is our case study plumber, and he helps us understand some of these concepts. So a prime example of an asset for John Tapp, our case study plumber, is his van. Okay, he's got a van that he may have bought, or he might lease, that is going to be of use to him over a period of time. Now it gets a bit hazy if he leases it, because actually does he own it? But if he owns the van outright, and then he can 100% recognise the asset within the books. Okay, because he's going to be driving it for 3 years or so until he decides to refresh his van, and he's going to use that to do jobs, so it's providing him with a benefit. Okay, some other examples of assets: buildings. If you decide to buy a building for your business, you're going to use it over 20 odd years, perhaps even longer than that. So there is benefit to you having that building. Money owed from customers. So on traditional method of accounting, we're going to recognise the customer owing us, say, £1,000 at the date that we complete the job that we did for them. Now, it could be that we give them 30-day terms, so they're not actually going to pay us that for 30 days. Okay, that money owed from customers is an asset. Okay, and we've got control of it, it's ours, we're due that money. Okay, other things, stock. Prime example, stock. So we've purchased some stock, we're going to sell it at a point in the future. That's when the benefit comes in, because we can use it to sell, and we will get the money for it back in a sale. Okay, and the other one is cash. So cash in your bank, you've got cash sat there, it's denoted as an asset because it's yours to use to spend in the future. Okay. Now on the flip side, we've got a liability. So a liability are the obligations that the business has that will be paid for in a future period. Okay. So a prime easy one to think about are loans and overdrafts. Okay. We've borrowed the money from the bank, and at some point we're obliged to pay it back to them. So we would recognise a loan or an overdraft as a liability in the books. Other liabilities, I said earlier about HP, hire purchase for the van. You can recognise the asset in the books as something that will bring you benefit, but under HP you haven't yet bought it all, so you're committing to pay for that over a period of time. So it could be that you have 2 or 3, maybe 4 years worth of payments to pay. Every time you make a payment, that liability will be reduced. Similarly, another common one is supplier invoices. So John Tapp bought his bathroom suite that he was going to put in Mrs. Brown's bathroom, okay? If he paid for it in cash, there is no future liability because he's settled that already. But if he's got a really great relationship with his suppliers, they might offer him credit terms. So it might be 14 days on account, or it might be 30 days. Some, if he's lucky, maybe up to 60 days. So i.e. he's getting the receipt of an item now, but he doesn't have to pay it till the future. So his obligation to pay is in the future period. Okay, so that is really common liability to see. And the last one that I think is worth mentioning are taxes. Okay, so things like payroll tax, corporation tax, VAT, these all become liabilities, okay, because quite often you'll find out how much you have to pay. So payroll, every month you get your P32 with how much your tax liability is, but you don't actually have to pay that till the following month. Corporation tax, you get 9 months and a day after the year end to pay. So you'll put the liability in the accounts at the year end, and then you pay it when you pay it, and the liability reduces. Okay, so those are all really common liabilities. So just to reflect on that then, the balance sheet is just a report, and it sounds really scary with the word balance sheet. It's a bit unknown, what does it mean? But it's just a report that shows what your assets less your liabilities are. So let me give you an example over on the next slide here. Okay, I'm just going to move across to this side. So this is an example of John Tapp's balance sheet. Okay, it's not a real one. I've just made this one up. Don't worry. So here we go, and ignore obviously the columns with the black writing are what the actual balance sheet are, and the blue one are my notes. So for example, fixed assets. Okay, what does this mean? Well, it's saying that he's got £40,000 of fixed assets. Fixed assets are good, so they're his van and his big equipment that are included in there. And then he's got current assets. So current assets are debtors, so that's what we call the amounts due from customers, and he's got £10,000 that's due from customers. And then he's got 25 grand sat in the bank. So those are all the assets in John Tapp's business. Then he gets his current liabilities, and I've realised I put trade debtors there, and that should be trade creditors. So this bit here, I'm going to see if I can just quickly, oh no, it's not letting me do the pen on there today. Anyway, this bit here should say trade creditors rather than debtors. Apologies for a typo in that one. So current liabilities are obligations that he owes out. So he's got amounts due to suppliers of £7,000. So these are the things that he's had on account and he's got yet to pay for. He's also got some VAT payable for £4,500, and he's got some corporation tax payable for £12,000. Now I've put corporation tax in here just because it could be a limited company. John Tapp is currently in some of our exercises as a sole trader, so wouldn't necessarily have corporation tax, but would have income tax payable instead. So there we can see that his total assets that he's got are £75,000, being the 40 plus the 10 plus the 25. And then he's got his current liabilities of the 7, the 4.5 and the £12,000. So overall, his net assets are worth £51,500. Okay, and then the bit at the bottom is the capital and reserves, which is how it represents how that is split into share capital and profit and loss that he's accumulated over a period of time. So that's just a quick example of a very simple balance sheet that you might see. And I wouldn't expect for most businesses that there'd be many more significant complexities on a balance sheet than those that are written here. Okay. So just introducing you to this concept for a moment. So the balance sheet will form the second important report, aside from the profit and loss, for small business accounts. Okay, now that's if you're adopting the traditional method of accounting. For cash accounting, the balance sheet doesn't really exist in the same form because you're recognising everything anyway. So actually all you'd have is cash and reserves, and that would be it. Okay, so why is a balance sheet really important? Well, one, it helps us get a handle on our traditional accounting and is essential that we do it if we're doing traditional accounting. But two, there are so many key ratios and key financial information tied up in this balance sheet. Okay, and if you don't start looking at it and digging into it, you don't know. So if we take the debtors, for example, we can use this balance sheet information to find out how long it's taking for our debtors to pay us. How important is that information? You know, if it's taking them nearly 180 days to pay, we've got a problem with our debt recovery. We want our money quicker. Okay. Similarly with our trade creditors, if we've got to wait to extend our credit terms because we simply haven't got the cash coming in to pay, then obviously that will tell us a key bit of information about our business. Okay, so in order to use the balance sheet to the best, we need to look at some key ratios as well. Okay, so what we're going to do over the next 5 weeks or so is delve into the really important parts of the balance sheet and take one session to understand each one and some of the key learnings for those things. So we're going to look at fixed assets, we're going to look at debtors, cash at bank, creditors, and there's another one that eludes me at the moment. Okay, so over the next few weeks we're going to delve down into each one of those sections and learn the basics about what we can expect to see and some of the tricks of the trade in those. Okay, so that's what we're going to have a look at. So your takeaway task for today is to sit back and have a think about what you would have in your business that would be classed as an asset. Remember, a good resource for future benefit. And what would be classed as a liability, i.e. a contingency or something that you will have to, an obligation you have to pay for in a future period. Okay, make a list of each. It doesn't have to be long-winded. If you need some inspiration, have a Google and see what you can find. And then as we work through the balance sheet, you'll be able to relate each of the subsections we're going to look at back to your list. And then you can start figuring out what your balance sheet might look like. Okay, so a little takeaway task for today. Hopefully you'll find it relatively simple just to think about your business and what that might look like. Okay, well that's everything. So we're going to come back next week and we're going to start looking at fixed assets. So if you'd like to join me next week, then feel free to keep an eye out for this post. If you miss me, then that's fine. Head over to YouTube channel and you'll find all the episodes on there, or alternatively go over to my website www.charwithassociates.com because they're on there as well. And don't forget, if you really are struggling to get a handle on any of the accounting terms or anything else, then just ping a message over to me. And also, if you would like to sign up for my super easy bookkeeping template, you can also find a link to that on my website right at the top of the first page. There's a sign up now and you will get the easy template delivered straight to your inbox. Well, that's everything from me. Have a great week, everybody, and I will see you next week. Take care.